Good morning, everyone, and a very warm welcome to today's webinar. It's a pleasure to have you all with us. Today's session is especially meaningful as we celebrate Sovilo Investment Manager's third anniversary, and we thank you for all your continued trust and support in us. In recent times, global markets have been influenced by geopolitical developments, economic shifts, and rapid technological changes. While uncertainty has dominated the headlines, it also sets the stage for new opportunities. Today's session, World, once the crisis settles, outlook and opportunities, will discuss on what the world post-crisis landscape could look like, the outlook for global and Indian markets, and the opportunities investors should watch in the coming years. We are delighted to have with us Mr. Sandeep Agarwal, co-founder and fund manager at Sovilo Investment Managers, who will share his view on the evolving global environment and their impact on Indian equities. Joining him is Ms. Padmavati Udecha, head of research at Sovilo, who will add valuable insight to the discussion. Today's session will cover the following themes: quick update, equity markets, geopolitics, and technology, financial year 2027 outlook and future opportunities, Sovilo perspective as well as strategy. I would request all the participants, if you have any questions during the session, please feel to drop them in the chat box. We'll be taking them during the Q&A session. With that, I would like to hand it over to Mr. Sandeep Agarwal to take us through his views.
Yeah, hi, thanks, Niteshji, and thanks everyone for joining us on a Saturday morning. We really feel delighted that you keep on coming and attending our sessions on weekends, which is a Herculean task after a very busy life in the country. I am, as Niteshji mentioned, I am joined with our very bright head of research, Ms. Padmavati Udecha. She has a bad throat today, so she will probably speak less, but she is with us. And we also have a AI expert with us, so Ariman Iyer, who will speak on the technology slides along with me. So I will just start, and we will take all the questions you have. So just basic hygiene. Good thing we have finished 3 years despite getting 20 months of very turbulent time in the space we operate, that is the small and mid caps, and we have survived. It was quite painful journey, but I think we have come out of it. Uh, these are our philosophies, and these are our few of achievements which people who have been joining our webinar for a few months would know. So I won't spend much time. It is there in the records to see. Uh, so what has changed since we last spoke? That is, we will give you a quick recap on that, and then we will move onwards. So if you recall that, when we were speaking last time, then the performance of Indian indices was very muted. In fact, we were massively underperforming the all the other countries. I think there is some feedback from some client that there is a lot of echo happening. I don't know why it is happening, because we don't have multiple systems here. So if it continues, please do ping us again. We have switched off some noise which was there in the background. So continuing. So Indian indices have shown little comeback, and I would say that more than little comeback, as we have highlighted in our note few days back, and also we spoke in the last conference, last webinar of ours, that while some of the markets have done phenomenally well, because they had the offering of AI and we did not have that offering, and smart money wanted to quickly move there, and that is what also led to our underperformance. And added to that, our earnings growth was quite muted, and also we had a lag effect of the RBI tightening which happened in late 2024. I think we all those things have now faded away. What has not faded away is the phenomenal growth in the AI components. So basically, right from the GPUs and from the storage and the memory units, the demand remains quite robust. In fact, uh, I was listening to the CEO of this Samsung, Hynix, all of them, and they are saying that now what they are doing is they are taking advance at current price, which is 40, 50, sometimes 80% higher than the price few months back, and they are locking in contracts at that price for 2028. So means that they also know that this prices and this demand is unsustainable, and hence they are providing hardware to only people who are able to lock in at current prices, which are astronomically high prices, and for next 3 years. So I think there is some worry in their mind also that this price may not sustain, and hence they are also trying to safeguard their future revenues. Having said so, I would reiterate that we are little bit back on track for two reasons. One, those markets which were super attractive, while from earnings perspective they are not any less attractive, their multiples still remain 7-8 times forward. But people realize that 60-70% weight in two or three companies could be extremely risky, and they won't get an exit chance if something goes wrong. And hence, they are trying to come back to some other markets where they see that there has been a good time correction, and the multiples have also corrected. So the advantage with India is that the underperformance has been massive, and because of that, a lot of money will again start, or a lot of money has also started seeing India in the primary side. In secondary, that is the equity market, also I think at some point of time it will come. So primary side, you would see that a lot of transaction has happened in NBFCs like Samman Capital, RBL Bank, Seram Finance, now Adani. So many things have happened. So I think sooner or later you will see that follow on happening in the secondary market also. So if anyone has any problem with English, please do message. We will try to mix with Hindi a little bit, because when we speak in English, then there Hindi, then there is feedback that please speak in English. So I don't know what is the right way, but if anyone has big problem, we can obviously dilute the English we are talking. So next is the crude. So you all have seen how crude has played out because Hormuz was completely choked. So we have seen 118, 120 barrel jump from 70 to 118, 120 barrel, which is honestly a non-structural and a trading kind of move which has happened. If you see the world from 2021 to now, last 4 5 years, the world has moved on to renewable in a very very big way, and the more the world moves towards RE, the dependency of oil on different uses starts going down, and which has been happening. So I believe that if Hormuz opens up and there is not so much of choke there and things start flowing properly, Iran sanctions get over. Honestly speaking, I was reading a very good journal on Middle East, and it was saying that the per day supply of oil is now incremental supply is 8 million barrels per day, and incremental demand is just 2 million barrels. So 6 million barrel per day is the differential, which is a huge differential. I have not seen such kind of differential in last several years. So the knee-jerk reaction in crude, which you saw a few quarters back, where for a short span of time crude went into negative. I will not predict that, but I will also not be surprised if crude goes to sub 30, sub 20 level for a short period of time. While I think sustainably crude is a $50 around product right now, and every 3 to 4 years as RE takes over, I think crude should lose every year like 2-3% of its value. We have to see, but again, because there's so much of vested interest, and China and India are heavily dependent, still heavily dependent on crude, and the suppliers, the OPEC nations knows this. So they generally try to control the supply to keep the prices up. But at some point of time, I think someone will blink, particularly if Iran sanctions goes away. Iran is in desperate need of money, and I think Iran will glut the market with supply if there are no sanctions. And when that happens, then these countries which are artificially keeping prices up for last 20 years, probably they will also give up and start. They will realize that they need to just get the stock out, otherwise it will become irrelevant. So that is one. Second, US FOMC, if you see how Kevin Walsh, the new Fed chairman who has come in and has a lot of backing from President Trump. Uh, uh, he was supposed to have a very, very dovish tone, but he has also a hawkish tone because he has to, his decisions and his tone has to be driven by the underlying inflation numbers. And inflation numbers honestly are not looking very good, and that is also one reason that Iran has been able to get through this negotiation with US, because it was able to find out that President Trump has to go into elections in next few months, and he cannot have such a high inflation. uh, Third, yeah, so there is a request for a Hindi and English mix. So we will try to dilute our language a little bit. And again, it is open forum. So if anyone finds too much of Hindi, please again highlight. We can again shift more towards English. The third is the RBI. So RBI we have seen that अभी तक RBI ने कुछ बहुत ज़्यादा किया नहीं है. They have behaved very maturely, I would say. उन्होंने कोई नीजक रिएक्शन नहीं दिया है. वो ये देख रहे हैं कि आम आदमी को इन्फ्लेशन कितना हिट कर रहा है, कौन से कंपोनेंट हिट कर रहे हैं, एंड दे आर बेसिकली trying to balance that. And I feel because RBI is very very, I will say that last 40-50 साल में 2 या 3 दफा ऐसा हुआ when RBI has been so calculative and so prompt. तो अभी RBI को पता है कि क्रूड अगर कंट्रोल में आ गया तो इन्फ्लेशन इतना बड़ा वरी नहीं है. तो आई थिंक inflation honestly because of inflation alone at this juncture RBI मेरे को नहीं लगता कि बहुत ज्यादा कोई एग्रेसिव एक्शन लेगा रेट पे. although the cut chances of cut are gone, but I don't see कि they will reverse policy stance so quickly. Then we all know कि अभी आप लोग तो बॉम्बे में हो, तो आप लोग 4 दिन से 3 दिन से बहुत बारिश देख रहे होगे, तो आपको नहीं पता चल रहा होगा, बट many parts of India are not has not received rainfall. We are quite deficit this time. 42% rain deficit was there, which is third time in 100 years, and this will weigh on agriculture. बट मैं थोड़ा आपको बताना चाहता हूँ कि जो हमारा जो इरिगेशन सिस्टम और डिस्ट्रीब्यूशन ऑफ वाटर है, वो लास्ट 10-15 ईयर्स में बहुत इम्प्रूव हुआ है. एंड from personal experience, and this is along with some very senior people, I can say that top 15-20 people of the stock market were there. We were in Tadoba last week, and we saw that the whole jungle was completely green, and also the farmlands nearby, outside border and everywhere, it was quite green. So water table was good. Now water table will deplete if we don't get good monsoon and good spell right now. तो आपको टेंशन होगा नेक्स्ट ईयर, क्योंकि अभी तो डैम में भी वाटर लेवल्स इतने खराब नहीं है. कोई एक आध जगह थोड़ा प्रॉब्लम है, बाकी सब जगह डैम में भी लेवल अच्छे हैं, एंड लैंड में भी वाटर का जो लेवल है दैट इज क्वाइट गुड. तो इतना चैलेंज मेरे को नहीं लगता कि अभी इमीडिएटली आएगा. बट आपका अगर ये मानसून वीक होता तो उसका बड़ा इम्पैक्ट होता है कि ठंड जो होती है वो बहुत कम होती है और एग्रेसिव शॉर्ट पीरियड के लिए होती है. वो आपके क्रॉप्स को बहुत खराब करता है, एंड वो फूड इन्फ्लेशन पे आके बहुत गंदी तरह हिट करता है. तो इट विल नॉट मैटर कि जून में बारिश तेज नहीं हुआ. ऑब्वियसली इट विल मैटर, क्योंकि सोइंग कम हुआ है, कुछ कुछ नुकसान होगा, बट अपने पास खाद के भंडार, फूड रिजर्व्स आर गुड. ऑब्वियसली फार्मर्स विल बी अंडर सम स्ट्रेस, बट ऑन द अदर साइड अगर अभी जुलाई में भी बारिश हो जाता है एंड मेकअप हो जाता है, तो अपना जो बड़ा प्रॉब्लम है विच इज शॉर्टर विंटर एंड अ वार्मर विंटर, वो नहीं होगा. अगर वो नहीं हुआ तो अपना जो एग्रीकल्चरल इनकम एंड cycle and chain, and that will not be impacted much. So we are all praying for that, and I hope that winter the monsoon is delayed but not a deficit monsoon. Then finally आपने करंट अकाउंट का डेटा देखा होगा Q4 का, एंड अपना करंट अकाउंट में सरप्लस था Q4 में, एंड वो हमेशा Q4 थोड़ा स्ट्रांग होता है बिकॉज अपने एक्सपोर्ट्स एग्रेसिव होते हैं. अब अप्रैल में अगेन अपना थोड़ा डेफिसिट है, ज्यादा आया है, डेफिसिट आया है, और वो हमें पता है क्यों आया, बिकॉज ऑयल प्राइसेस वेयर ऑलमोस्ट एट पीक इन अप्रैल, एंड ऑल्सो कोल भी हमें इंपोर्ट करना पड़ा है फॉर पावर. सो सब मिला के थोड़ा प्रेशर है, टैरिफ का भी प्रेशर है, उससे यूएस एक्सपोर्ट भी थोड़े हिट हुए. बट आई थिंक थिंग्स आर नाउ रिटर्निंग बैक, unless something again comes out. Very difficult to predict what will happen with Russia, Ukraine Middle Eastern countries, Iran and all. उसीलिए if you see the title, we have chosen the title very carefully. We are not predicting the crisis has settled. We are saying that world once the crisis settles. So अगर crisis settle हो गया तो क्या होगा, हम उस पर अपना view दे रहे हैं. Crisis settle कब होगा, कैसे होगा, we don't know. It is, I don't think anyone can predict that. But I will say this, that US stake in the war और US के जो position है, that is not very strong. So I think this should not again flare up. वापस से नहीं चालू होना चाहिए. That is what my view is. Next slide. Yeah. So this is our multi-cap scheme, which is our flagship scheme, which is a little low risk and lower risk compared to the other scheme, and the performance are in front of you. While we have done a decent job in beating the BSC 500 TRI, which is our comparable index. We have also outperformed the Nifty 250 TRI, which is an additional index which we compare our returns with. Nitesh, would you like to take these two slides?
Uh, if you see the performance across the board, our true comparative benchmark is Nifty Small Cap 250 TRI. Due to compliance issues, we have to follow SEBI norms and we have to give BSE 500. But honestly, if you ask me what is a comparable benchmark, it's Nifty Small Cap 250 TRI. If you see the performance across the board, we have been able to do a reasonably good job and have beaten the benchmark across majority of the time frame. If you take 1 month, which is a shorter period, but I'm just sharing the data, the 1 month performance of the scheme is 4.44% vis-a-vis the benchmark of 4.34%. Over the 3 months period, we have done extremely well. The performance is 26.90%, vis-a-vis the benchmark of 24%. 6 months, 8.63 vis-a-vis 6.41. 1 year, it is reasonably, there's a good amount of outperformance where the scheme has generated 6.05% return vis-a-vis the small cap in return of only 0.15. In 2 years, we are at 7.14 vis-a-vis 2.36, and over the 3 year horizon, we are almost close to 20% compounded return vis-a-vis the benchmark of 19.61%. And since inception, which is probably close to our 3 year return as well, we are at about 20.44% vis-a-vis the benchmark of 20.28%. Sandeep ji, you can.
Yeah, so I would only say one line here. So if you ask me, are we happy with this? I am certainly not happy with the performance at all. We want to be much better, and I think we will be much better. Uh, while at compared to Nifty Small Cap 250 TRI, we are little underperforming in STRA and outperforming in the SIML scheme. The challenge is that there is a very lopsided performance within the Nifty 250 small cap. And if you see, many of the stocks, some of which we also hold, has not at all performed despite very good earnings growth, because the right now people were following initially the water trade, and then they shifted to somehow play the data center trade through wire cable and transformer and on. So the trades are consistently changing without being fundamental in nature. So there is a lot of euphoria. There are companies which are growing at 6-7% in terms of revenue growth, 9-10% in profit growth, and the stocks are at 100 times, 90 times, 95 times. We honestly don't have guts to buy them. We understand the long-term story and all those things, but I believe that if you buy at a wrong price, you may not make return for 3 to 4 years. So I believe that if no new accident happens on the global macros or war or anything, definitely the stocks which we are holding with very high earnings growth and very low peg ratio, they are the ones who will expand in returns in a substantial way. And we are already seeing last 1 day, 2 day, 3 day, 4 day, as things are stabilizing, we are seeing consistent outperformance. It takes time to show up in a longer time horizon, but I think in next 1 or 2 months we will cover whatever small gap is there in one of the schemes, and we will massively expand the gap with the bigger scheme. So we are very confident we aspire to do 5-6% additional return than the indexes, and I am confident we will do that. That is the reason we have a team, one of the biggest research team in the country, which is comparable to any large mutual fund or any large PMS. So we have invested heavily in research. Maybe because of that also we are struggling. We have not been able to generate returns the way the euphoric stocks have given, because those are more probably technical in nature or momentum stocks. We don't have any momentum stocks, all are fundamental, and we continue to invest in them, and we are also investing in future. So I'm very confident that in next 1 month or maybe 2 month maximum, you will see a very very big outperformance on our part. Outperformance has already been there in SIML. It will increase substantially from here. Next slide. Araman, you want to take this?
Yeah. Good morning, everyone, and thank you for your time. So, since last time we discussed AI, there have been quite a lot of changes. Now, I'll keep it simple. The question has always been the same. We are in a bubble. Are we in a technological bubble or are we in an economical bubble? So, if I look at the technology side of it, the developments have been faster than ever. Anthropic released its new model, Fable 5, which was also taken off from consumer usage because the government deemed it too powerful to give to the people. And now, just recently, around yesterday, the model came back online. And we also have reports from Google and Anthropic that a majority of their code is now being written by AI. 75% of Google's code and 70 to 90% of Anthropic's code is now completely written by the AI model themselves. We also have leaps and strides in the physical AI space, where the new figure bots that we talked about last webinar are now being used in real world scenarios on the assembly line of BMW. And they have assembled 30,000 plus cars as of today. So, the answering the question, I do not think we are in a technological bubble. AI is definitely here to stay, and it is definitely here to drive us into the next frontier of accuracy with work, with efficiency with work. So now the real question is, then where is the bubble? Can we go to the next slide? Yeah. So, AI has now become one of the biggest bets globally. Almost every market that has gone up significantly has had something or the other to do with the AI theme. And now with SpaceX IPO coming into play and XAI being one of the biggest revenue constituents within SpaceX, and as well as having OpenAI's IPO on the horizon with a $1 trillion alleged valuation, and Anthropic's current valuation at around $900 million. We have $2 billion IPOs coming, $2 trillion IPOs soon coming. And with this, the question really stands, how much concentration can we really give to one sector? Now, India here is the only market where we really have a good amount of diversification. Yes, we have made significant developments into investing into our own AI potential. We also have our own Indian AI model called Sarvam, and those have been doing quite well. More on that on the later slides. But the sentiment is clear. There are all of the major investing bodies, as well as high ticket names like Burry, Dalio, and Diamond, are all saying that the market is increasingly leveraged, and eventually there has to be a correction. And if you see the US market in the last few days, these AI names have significantly corrected. Nvidia, which topped out at a $5.5 trillion market cap, today stands at $4.7 trillion. So we are eventually seeing a rationalization in the prices of these AI names, and it is simply not possible with these new IPOs coming that the max 7 go to 8, 9, or 10 companies eventually. So there has to be a significant correction on the pricing terms. The technology is definitely here to stay, but the token economics still does not make sense at all. So some rationalization will eventually come into the market, and we have to wait and watch for that. But as far as the technology part of it is concerned, we are crossing new leaps and bounds every single day. That's all from my side. I'll pass it on back to sir.
So now, I will also come to IT slightly later on, AI and IT, because it is my favorite subject. But let me finish quickly this one. So crude oil movement, and we have shown it, and we have shown it in the past also several times. So you can see it has been moving up and down, up and down. The situation is not as volatile and sensitive as it was some few weeks back. It is now in a much better shape. but still I will not say it is completely stabilized. So one comment which I would like to share is that yesterday the Petroleum Minister Hardeep Singh Puri was saying that you know the diesel and petrol price, if crude remains here at 70 odd dollar per barrel, then in next 2 to 3 months there is a fair chance of substantial cut in the petrol and diesel prices. But he doesn't forecast before that it happening, because there has been a lot of under recoveries. I think it is to the tune of around 3 lakh crores, and they need to cover that to some extent before they can reverse the process again. So let's see. So I'm not. We don't foresee any quick relief coming on that front. And also, to be honest, there is no election immediately anywhere, which is a material one. So I don't see any reason for the government to come and cut the prices. Yeah, Ariman, next slide, please. So, this particular slide, I think we have shown in great detail in past also, and I will reiterate that, India is a very, very broad-based market, unlike some of the markets which has massively outperformed, like the China market to some extent, but more Taiwan and Korea. I think, we did not have an AI offering like them, and we are always very expensive compared to them. Even today, based on the forecasted earnings of Korea, uh, they are at 7x forward earnings. We are still at 19-20 times forward earnings. So there is a huge gap in the multiples, but at the same time, our country, there is a terminal value. So the comparisons are generally wrong. Many people on the TV come and say that, we are 3 times expensive, 2.5 times expensive. I think it is a very, very wrong comparison, because when you do valuation, there has to be a terminal value. Our terminal value is much, much higher than the terminal value what Korea and other markets will have. So, by the way, I think we have shown it in the last webinar also, that all this market, despite performing so well in last few years, their last 30-40 year returns are zero or negative. So these markets can have return for 2, 3, 4 year period, but on a longer period of time, these markets don't generate much return, because the population growth is minuscule, the per capita jump in income is also not very significant, and the consumption patterns are not very high growth. Next, Ayman. So yeah, so this is what we were talking. You can see Korea, there is 55% market cap is between Samsung and Hynix, and Taiwan 42% is TSMC alone, and in US even 33% is Maxon. Although I'm little less worried on the concentration in US, I'm more worried on Korea and Taiwan. Next. Yeah, so this is where it is, and foreign ownership, as you all know, for FIs have been consistently selling, and they are going to markets where there is AI offering, and also they feel that those markets are much cheaper, and because of that, we have seen a record selling in India. By the way, very interesting data point is that India last year and this year together have seen around, I think, 45 billion 50 billion of FI selling, and Korea alone in last few months have seen $60 billion of FI selling. So FI outflow is very aggressive even in Korea. Next, Ivan. So this is very, very interesting, and this is the right side of the slide is what I was referring to, that while our secondary market FIs are existing, but they are coming into the primary market and they are making very structural investments. You can see the 6 investment mentioned in the right hand table. And second thing which answers your question, why we prefer the SMID space, that is the small and mid cap space. You can yourself see the kind of outperformance which has happened, and this outperformance is not only because of not the stock price outperformance only, which we are excited about. We are very much excited and more excited about the fundamentals behind it. So if you see the large caps, last 5-10 years have underperformed the mid and small cap by 6 and 8% in terms of earnings CAGR also. So we believe that mid and small cap has a huge earning growth ahead, which is much more substantial than the large cap, and that is the reason they are doing well. So that thesis remains intact, and I continue to believe that thesis will remain unchanged. Next, Ariman. So, this is a very good step, I think, by the government, where, everyone has a different number, how much money will be, foreign exchange will come through this FCNR and will release the pressure on the currency. There are estimates of 50 billion, 80 billion, 100 billion, but I think it is a very big number which should come. By the way, just let me tell you, I was speaking to a very, very big FII investors, and they are putting multiple applications to grab this opportunity. So I don't know if you all understand, so I will take just 30 seconds to explain how it works. So it is simple that, if you are an NRI, what you can do is you can go to HDFC Bank or ICICI Bank or SBI bank branch in your country, in the country where you're residing, and you can, let's say, put $100 to buy a bond, and when you put $100, $900 will be put by the bank. So total 1,000 rupees, for example, or $1,000, and then you will earn guaranteed interest of 6% on that. So basically, your total return in a way is 15%. I don't know whether you get that. So on your investment, you are making 15% return because you are putting $100 only as equity, on which you are making 6%, and the $900 is being put by bank, and you make 6% on the full this full thousand, and you are paying interest to the bank on 900. So that is the way it works. Now, why it will work? Because banks don't have any problem. RBI is taken the guarantee to, defend the currency laws. So what now? The question which is happening, which is coming from everywhere, is that for this 100 billion, why RBI, let's say in 5 years, the currency appreciates by, let's say, 15%. So RBI will have additional liability of $15 billion because currency laws they have to fulfill. So why RBI has taken such a big risk of 15-20 billion dollar of loss for a amount of 100 billion? And if you see practically, it is not even 100 billion money which RBI will get. What is going to happen is 10 billion only, because if you as a NRI are putting 10 billion, 90 billion the bank is borrowing and giving it to you, and you are buying then $1,000 bond of India. So basically, effectively, RBI gets 10 billion of NRI money. For that, it is taking 15 to 20 billion dollar of currency risk, but it will stabilize the currency and it will bring a lot of money. That is the thought process. So this is more to do defend the currency on a structural basis than anything else. It is a very good product for people who are in Middle East, where the tax laws are quite clear, like Dubai. There is a lot of ambiguity on how it will be taxed in US and UK, because what you borrow at the $900, the interest which you pay, I think it is not allowed as a expense out of the total income. And if it is not allowed as an expense, then your tax implication is much higher. So you will not make that, the returns will not be lucrative in that case. So it depends which country you are. Next slide. Yeah, so this is another positive sign which we are seeing, that after a long time, without much change in the credit cost or delinquencies, the credit growth has started showing up. It is picking up a little bit, and asset qualities are probably at the best. And interestingly, the bank's valuations are at 5-year old valuation or lower valuation, and I will explain you why that is also happening. Next slide. Yeah, so this is again continuation of the previous slide. The price to book of the Bank Nifty has fallen to a very low level, despite very good performance on the NPA side and very good growth again, reflecting. Yeah. So this is the point, BFSI. It is very interesting point. So if you see last 5 years, the private banks have lost 15 to 25% market share in different categories of loan to the PSUs. The challenge is that private banks were always saying that we will make 1.8, 1.9% ROA, and the PSUs has only committed 1%. And what is happening, because the credit cycle is good, PSUs delinquency rate and private sector's delinquency rates are also same, and PSUs are giving loan at a lower price than the private. So no one is willing to give private banks the same multiple premium which they were giving just 5 years back. So if you recall, private banks used to trade at, like, 4 times book, 5 times book, and PSUs were at less than 1 time book. That gap has been consistently narrowing, and it is narrowing because public sector banks are consistently gaining market share from the private banks because they are charging lower rate of interest. They have better franchisee to collect deposits from the rural areas because of their branch presence. And third, they are okay with slight poor quality of credit versus the private banks. And now private banks are completely choked. They don't know what to do, because if they compromise on the credit quality, then of their multiple will further squeeze. If they compromise on the NIMs, that is the interest rate, then they also their multiples will compress. And if they compromise on the ROA also, then their multiples will squeeze. So it is very difficult situation, and that is the reason Bank Nifty is not performing, because Bank Nifty, lot of component is of the private sector banks which are underperforming. So that is one. Pharmaceutical is one space which, if you recall, last 2 years we have been consistently very, very positive. Although we regret selling Laurus Labs quick early, because we got in at a very low price, almost at the bottom at 300, and we sold at 800, 900, and 1,000 rupees. Now it is at 1,500. We regret that, but I think it is now getting into the euphoric phase in terms of valuation, because we have taken the most bullish numbers on Laurus Labs, and we have taken even higher estimate than that, and still it doesn't make sense to hold them. So what we have done is that we have shifted our expensive CDMO bets to the less expensive CDMO bets, and the generic ones like the Innova Captab you would have seen, and also some extent Biocon, which is not exactly CDMO, and few other names, Kaplan Point and Aurobindo. Also, we have invested and made very good money in a very short span of time. Now we are betting big on Alivus. So there are few names where, so pharma remains very, very constructive space for us. We believe that next 5-10 years, the pharmacy, India will remain the pharmacy of the world. We don't see challenge in two spaces. One is IT and one pharma, as from China, primarily because in case of IT, it is the data where trust is required, and in case of pharmacy, the medicine finally goes into human body. So these two spaces, I don't think China can compete with us, because they have a very high trust deficit with the Western world. IT, I will spend 1 minute quickly, because there is a question on the personal wall also from someone. So let me quickly tell you what is happening, and I explained it on multiple channels in last few days in my appearances also. So what is happening in IT is that people are confusing the disruption with the cycle. So disruption and cycle are both different. So cycle is always same, and disruption is always different. So if you see last 20 years, we have seen 3 disruption in IT services space, in the software space. And what happens? Technology changes. So when technology changes, obviously we are not the one who innovate the technology, and we have to keep waiting for the technology to stabilize. And during those 18 months, 24 months, when technology stabilizes, because our companies are more into training the people in that technology and providing, till that technology stabilizes, we cannot train our people and provide, right? So that is the biggest challenge, and that is the reason you have seen such a sharp correction which has happened in IT space. I believe now that now the correction is overdone, and we were at zero weight, almost zero weight in IT few months back. We have added up around 8-9% weight in last 2 months. We will further add up, because I am very confident that the first phase of this disruption, which is the hardware-led disruption of the GPUs and all, that has been very good, and that has played out to a large extent. The second will be the operational and the commercialization of it. So the modular players, I think they will continue to do well for a longer time, where your some of the participants from Mag 7 and the new players are there, Anthropics, the group, the Geminis and all. And then servicing of this enterprise clients and building of those AI agents who can write the codes will happen, and that is where we have a very strong moat, and I think that business will come to us. So I believe that this will be the last bad quarter for IT, and from here on you will see good positive development. Let me reiterate, I am not saying this is a high growth sector. In my view, next 5 years IT will be low growth but high on profit growth sector, but the current multiples don't justify the current valuation, don't justify at all what it is. I believe we will make money from here. We were doing some numbers, and I believe that the earnings growth for next 3 years in IT should be around 45 to 70%, depending on the companies. And if that happens, then of course, we will make, even if the multiples remain same, we will continue to make that 50-70% return over next 3 years, which translates into 17-18% CAGR, which is a very good CAGR from earnings point of view. If we get 20% re-rating, then we will make 25-26% return, which is a decent return in well-run, well-managed, low multiple companies with low risk. Then comes the manufacturing and cap goods. We have always reiterated consistently that this is one space which we love a lot. And the reason is simple, that, if you do a 200 crore rupees of capex, 60 crore is core machinery which you import, for which we don't have immediate solutions, but balance 140 crore is around ancillaries and the utilities which move around them. For example, you have to buy the land, you have to plaster the land, you have to build the switch gear, you have to build the transformer, you have to put all the electric systems, you have to put the electric cabinet. So all the ancillaries and utilities around it, which is around 70% of the total capex. Fortunately for us, in that capex, you won't find, very in that capex, the logistic costs involved are very high, and you have to, most of the times, you have to integrate and the solutions at the spot in the factory. So the competitions are generally very less. So we love this space. You would have seen we have a very high interest in some of the engineering companies like the Mamta Machinery, MNB Engineering, Harsa Engineering, ISGC. So many companies which we like in that space. Similarly, we like AutoAnk, because in AutoAnk, again, the components are very bulky in nature, with low value, so you cannot import them. So you don't have to compete with China and all in that space. So it is a long-term growth, and generally stocks are always at low multiples, so the margin of safety is high, and they do give good returns. So we are there, and we are also playing some of the crude oil reversal trades, like, we are looking at some paint companies, some resin companies, and some tire companies. We believe, tire companies should do phenomenally well. I think this quarter numbers will be weak because the rubber prices were at very high price, but so PNL may not look good, but the outlook looks very, very good. Next, Arman. So we every time when we do a webinar, we try to share few theses, and this time we have two new ideas, Reddington and Jyoti CNC. So Reddington, as you all know, that we don't have a direct AI play in the country except the data centers, and in data center also, there are very few players, and the players which are there, they are trading at astronomically high valuation. We are trying to play this through Reddington, which is a very, very good company. If you see the data, they have been a consistently growing company, profitable company, good ROE, a very, very professionally managed company. Now, what we believe is that the super cycle which we are seeing in the hardware across the chain, right from laptops and MacBooks and iPhones and the memory chips themselves and the storage devices. So Reddington is one of the biggest distributor, I think the number one distributor in the country, in fact, and they have huge inventory. So I'm not saying they will be able to sell the old inventory at a new price, but what happens is that the push sell will go down, the pull demand is much higher right now. So the credit period falls, and the Reddington type of company with a turnover of 1.5 lakh crore rupees in revenue and all, these businesses should not be seen, in my view, in terms of EBITDA or profit. This should be seen as a price to book, and on price to book, this looks very good because it is basically a funding of the inventory only. So I think they will benefit a lot in the current environment. Their credit period will reduce. They will be able to sell high margin ancillary products with the main products, and also the inventory which they have, they will be able to sell it without any discount. So that is one idea which we like. The second idea, which is Jyoti CNC, it has fallen off very sharply from the IPO price. We did never participated in this company. We have almost bought it at the bottom of the price. It has half from the top. That is where we started looking at it. We like the company because we believe the CNC companies will have a very, very long future in India, because CNC machines are required in every industry. Even Apple uses CNC machine from Jyoti, if I'm not wrong. So the demand for CNC machine, as manufacturing sector keeps growing, will be much higher. So we are very positive on this space. Multiples are quite reasonable. Capacity is in place. Numbers have not come, and because of that, a lot of funds have dumped the stock. we like the space, and we are now investing in the space. We like these two ideas, like we have in the past also explained you few ideas. So these are the two ideas which we are very positive currently, and we are continuously evaluating and also investing in them. Next slide, Ariman. So this is the RBI's this risk forecast. So they are also flagging a little bit of risk on the inflation side. At the same time, they are also highlighting the crude relief. We will have as I mentioned earlier, that I am more worried about the winters, because if winter struggles because of deficit monsoon, then it will show up in the inflation, which matters to the government for political reasons and otherwise, which is vegetable and fruit. So we don't have any idea how it will pan out. Let's see. Let's pray that there is no deficiency. Water tables get back at good levels. In my view, again, as I already, I think this, I have covered this slide in the previous conversation. So the hike chances are quite low, but I would not say that if everything goes wrong and still RBI will not increase the rate. But honestly, I believe that the chances of rate hike are very, very low, because RBI will go more into the components of the inflation rather than the overall inflation itself. Yes, Ariman. Yeah, so this we have already spoken. Yeah, so we are seeing some relief, and I think with this $100 billion expected FCNR, you will see much more relief in this bond yields, and also with inflation. So this is broadly where it is, and I know there will be a lot of questions. I am happy to take all the questions, even if it exceeds our time. I will be okay to that. So Niteshji, can you start some questions?
Sandeepji, we have received few questions, but we'll just wait for a minute for further questions to be there in in the line. Okay, let me start with the questions that we have received. Sandeepji, the first question is on FII inflows. It is FII ownership is at 17-year low, while domestic ownership is at record high. Do you see this as a structural shift, or do you see any risk to domestic flows?
So see, I honestly don't see any risk to domestic flow, for the simple reason that there are three, four things which are happening. So if you leave aside the crude prices, what are there right now, structurally crude has to go down with RE adoption across the globe. Right? If you see our balance sheet of the country, we lose money on three fronts. First is crude, second is electronics, and third is on the gold. On crude, this is not the fair price of the crude. So if it comes to 30, 40, $50, we will save 50 to $60 billion on crude annually, which is a big number. Gold, I don't know how the government will handle. It is very tough to take a call on gold, but I don't think government can allow for infinite period a huge import of gold. Third is electronics. So that is the most interesting space. So electronics, before the crude prices jumped to such high level, was very close to be number one in terms of uh, uh, export of foreign exchange. But the good part about the electronics is that 5-6 years back, when we started as an assembling player in the world, the value addition which we were doing was less than 1%. Today we are at 16% value addition, and we have seen historically a classic case with our own country. In 1988, when Maruti came, 99% of the components were imported. Today, uh, less than 1% component is imported. So the space of localization goes up as your percentage goes up. So once you breach 20-25%, the technology transfers happen quickly, the ecosystem develops quickly, and the value addition in electronics and will go up further substantially. So if you see the three things which are burning our foreign exchange, going forward, the chances of them burning foreign exchange in absolute dollars remains high, which will be high because volumes will keep on going up. But as a percentage will continuously go down. When that happens, then your country's balance sheet gets a better rating, which will have. And by the way, we are our country's balance sheet is very, very good compared to most of the best developed countries. So my belief is that when that happens, then your rate of interest will tend down, and when rate of interest goes down, then the expected rate of return, um, um, uh, one, the expected rate of return of the investors will also mellow down a little. But second, the money which people make in FD will further go down. So right now, what is happening in FD is giving 6-7%, let's say, and equity markets, the fund where people evaluate versus fixed deposit, they are giving, let's say, 9-10%. So the gap is not big. But what happens when this FD returns goes down to 4.5, 5, and if equity markets gives 12, 13, the gap between those returns and this returns will increase. And I think that is where our low penetration, which is very low compared to the developed market today, less than 10%, it has a long way to catch up. So we'll do phenomenally well. So I think domestic flows will remain strong. Don't hold me responsible for 1 or 2 month blips, but structurally it has to go up. With tightening on gold, I think further more money will come in equity. Land records getting updated regularly, digital documentation happening there, lower usage of cash component in deals. Everything will push more and more towards equity, and so I don't have any doubt that domestic flow will not continue to be strong. They will continue to be very, very strong. On your question on FIs, I think, see, FIs have suffered a little bit because of our policies also. Government has changed the tax laws. All that. They have to pay taxes. More than taxes, the complexity of accounting is much, much more difficult problem. I was with the ex country head of Morgan Stanley India, and they also made the top brass of the government recently, and they said that you don't reduce the taxes, but at least reduce the compliance, because the reconciliation and compliance is very, very tough. So taxes, the compliances, those are also things which are irritant. But the biggest problem was that we did not have an AI offering, and I think as this AI euphoria starts pulling off, more rationality will return, and the pace of FI sell will reduce, and maybe they can come back also in a big way. As I said, that seeing FI flows only from secondary market is not fair. We should see overall flow, and as I said, and the data is there in the slide, 6, 7 primary investments have happened, which are very big ticket investments from the FIs, which is a substantial amount of money.
Uh, Sandeep ji, I would just like to add one more point over here. There are certain murmurs going on in the Delhi streets. The government may be launching a gold monetization scheme shortly. So that may also address the second point, which is the outflow happening because of the gold. The next question is, how are you balancing the opportunity in mid and small caps with valuation risk, especially after their strong bounce back from March lows? Have they again gone into expensive zone?
So, this is a very good question and very valid question, I would say. So, if you see our average price earning ratios, if you leave aside 2, 3 companies which are loss making, and they are the technology platform companies, the Swiggy and the urban companies and all, we are honestly very, very reasonably valued on our portfolio. And that is one key reason that we have not seen the kind of move which some of the companies like Happy Forging, Sansera, some of these names which are trading at 100, 110 times with 10% growth have seen, because we don't want to chase those euphoric stocks. So we always are very conscious about valuation. We will not chase or buy very expensive stock. That is our philosophy. And I have seen last 200 years of data. It is there in public domain. You can Google and check. Whoever has invested in momentum or expensive stock, even if they are right 9 out of 10 times, the one time they are wrong, it takes away everything. We don't want to take that risk with public money or our own money. I am very confident that we will definitely outperform. If we don't have the bad phase of last 18 months, our performance will start showing up in a big way in next 1 or 2 months. And that is all fundamental driven, earnings driven, and growth driven.
The another question is on the AI impact. It says, Sandeep ji, the investor agrees with your view on AI impact on the market in the FII India story. However, the current China economic data is weak. Will this impact FFI flows in India in 2026?
So, China has not received a lot of FI flow, to be honest. So I don't think it is India versus China in that sense. And I don't think as I said, that last 12 months of trade in the hardware side is still there. So I will not say that a lot of money will come out of Korea to India. I think if at all money comes out, it will go to US. I would put it this way, that I see more and more money coming in the primary market, which so the color of the money is same. So I don't know why anyone should not club that number when they release in the evening. Unfortunately, it is not happening. The kind of money which the Adani Group, the Ambani Group, and the NBFCs and banks have received is humongous, and it means that the good foreign investors wants to have strategic tie up and long term partnership with India, rather than trading money, fly out money. So I think we are building a strong foundation as a country, and this money will be more permanent and more as a partner money, and rather than a trading money. So we should not see the money in a different colors. We should see holistic picture, and on a holistic basis, I think a lot of money is going to come.
The next question is, what are the key drivers of Solilo's scheme outperformance versus benchmark, and what is our strategy to ensure outperformance over the coming years?
So see, again, very good question, and it is simple that we need to predict the future, and we need to invest in those. That is number one. So and we have always done it. Unfortunately, what happens that when you predict the future, either of the two outcomes happen. Either the stocks in that space are not available right now. You are facing same AI. There is no stock available. So how do you play? So we played it through transformer. We made a lot of money in transformer space. We sold. Classic case is Aquar Industry. We got at 6,500. We made quickly in 4 5 months 12,000. We sold because it doubled and valuation was not getting justified. Unfortunately, after we sold in 2 months, it went up another 30 40%. So those things keep happening. We don't have an option for that. But this is the way. So we should always forecast what is going to do well from sector perspective. So your sector should be a project. Right now, we believe that recycling will be a very very big theme for next 5 10 years, because the amount of metal which is lying above the land is more than what is the metal available below the land. So no way the world can afford to further dig from underground, and there is no need to dig from underground, because the cost of digging out and filling the hole is much bigger than recycling the what you have on the top of the ground. I believe that people are not seeing this still in a big way. There are not many listed players. Whoever are there, the numbers are not showing up, so there is a lot of volatility in the stock prices. The likes of Gravita we are holding for last 2.5 years. It has given us tremendous amount of pain. We have massively underperformed because of it. There are very few, and in fact, all recycling stocks are in the same way. I will tell you very painful story. We had Wabag for a long, long time. For 1 year, we did not make any return. We got frustrated and we sold it at our cost price. And after we sold in 4 months, it has doubled. Numbers have not yet come, by the way. So last 12 months numbers were good. Still, stock was not doing well. It was at 12 13 times earnings. Today it is at 50 times earnings. Numbers have not come. Still, it is going up. So sometimes narratives decide how the stock will perform. Unfortunately, narrative is a emotional content which we cannot capture in Excel and model. So it then becomes a very very gutsy call. Unfortunately, when you are running public money, you cannot take decisions on gutsy call. It has to be backed by data and logic. So sometimes you miss despite you identifying good. But let me tell you this, and I would reiterate at the cost of being repetitive. We have not built this organization for a short term, and to we are not there to just grow very fast at astronomical pace and all that. We always wanted to build a very very strong team, and that is the reason, if you see 3 years, a lot of that first half of that 3 years, almost 18 months, we have invested in building the right team. I can reasonably tell you that the people which are there in our team, you see the quality of those people, the experience of those people, the knowledge of those people. I would be comfortable saying that they are one of the best, and I continue to build that team. And I believe that if I have right team and right approach and right philosophy and policies, I may not perform in pockets, but in a longer period of time, we will phenomenally do well. and we are on that path. We are building our business portfolio in that sense, in that with that philosophy, and we are having, like I said, that we have a very different view on IT. So if you see more than 50 interviews in last 18 months on channel, I have gone and said the IT index will correct by 50%, which people were not believing, and the index has actually corrected by 50%. Today I'm saying it will do well from here. No one is again believing. So we want to go by numbers, and when you go by numbers, then the euphoria gets sidelined. Unfortunately, if you are caught in a wave of euphoria, sometimes you will underperform or may not perform the way you want to be. So I am very pained that I am not able to generate 26-28% return, which is my expected return for myself. But I am very confident that my processes are right and we will reach there.
Sandeepji, in the interest of time, we'll take the last two questions, and it is again on the IT side only. You have highlighted IT as turning bullish after 2 years of AI-led disruption. What gives you confidence that the worst is behind for Indian IT companies?
So I am not saying that worst is behind. I'm telling you this, that what happens is that most of the analysts also who are writing, the most renowned analysts from JP Morgan and CLSA, they are writing that it is a disruption cycle. So my only disagreement with them, and I know all of them well. They have come into the industry when I've already spent a decade and all, is that people are confusing disruption cycle as a one word. Actually, there are two words. One is disruption, one is cycle. So in last 25 years, I have seen that cycle doesn't change. Cycle remains same. Disruption changes. So in last 20 years, disruption has always happened on non-hardware side. So this is the first time when disruption is happening on the hardware side. So that is the only difference. Cycle will remain same. Disruption, the disruptor will be the first beneficiary. The person who uses disruption to commercialize it will be the second beneficiary. We are the service provider or the call centers of the world or the customer service managers of the world. We will only benefit once the product is accepted, stabilized, sold, customer is using, then we will service. Unfortunately, this simple logic no one is able to understand. So whenever a new technology disruption happens, we cannot grow till that product is tested, accepted, used, and problem comes, then we go and do problem solving. So that cycle, I'm saying, remains same for every disruption. Don't confuse it with disruption cycle as single word. These are two different words. One is cycle, one is disruption.
Sandeepji, the last question is, how do we balance between macroeconomic factors and company specific factors while selecting stocks for investment in our portfolio?
No, so always the call has to be on macro, because there are different sectors which will do well in different macros. So macros you cannot ignore, and that is the reason if you see our head of research background is all from economics. She was working with best economists in the country for several years. So we have always prioritized that. So we always take macro call first, that how the macro is shaped for next 1 year, 2 year, 3 year. And then the second layer of call which we take is on the sector. And after the sector, we see which stock is best. Obviously, the best one is well discovered, so it will be available at 4 times the valuation of the second best. So we will choose second best. That is the way we have always worked, and that is the reason our fund is a value fund. If you see the macro for next 1 or 2 year, our countries, what our government last 10 years has chosen uh, is that macro stability and return on investment versus scale. And because of that, our manufacturing has not picked up. China has chosen macro stability and scale for last 20 years, and that is the reason they are a manufacturing driven economy with 2 or 3% return on investment, because their money is funded by the government. The expectation of investors are very low, and investors don't decide and don't drive the growth. Government drives it. In our country, because we are a democratic country and the government's role is to run the country and not decide what to produce. The challenge is that the return on investment expectations of the investors are 20%, 18%, 15%. At those rate of expectation, you can't build large scale infrastructure and large scale manufacturing, because when you build larger capacities which are efficient, you have to take the hit on the returns and return on those investment. And because of that, you will see whenever our macro or our growth starts reducing down, immediately the central bank comes in and it pushes a lot of liquidity, and that liquidity finds its way in consumption, whether it is a home loan, home buying, or gold buying, or other consumption. So our government has always tried to push growth through consumption, while the model of China is always through manufacturing. So different countries have different models. Our country has a consumption based growth model, and that is where it is. So our macros will always remain good, generally. Yeah, if this crude would have been like 150, 160, and the crisis would not solve for 2 years, then no government can do anything. Your balance of payment will go haywire, and obviously your balance sheet will look very bad. But I think we are past that phase.
Sandeep, just 2 points, two more points probably. Can There's a question? Can you repeat the name of the stock on waste management which got
It
doubled in
was
four
not
months?
waste management, it was water management. So it is Vabag, VA Tech Vabag, which was there. It is not waste management, it is water management.
Okay. And what common mistakes do investors make during period of geopolitical uncertainty?
See, I will only say this, that the only mistake you should not do as an investor is that, uh, don't try to predict the world, don't try to predict the macros, don't try to predict anything. Whatever excess money you have, decide your asset class, keep allocating it. Everyone in the world in everything makes has grown or benefited by being patient. Uh, Trust me, I in my last 25 years of career, I have known the best hedge fund managers in the world. I have known best fund managers in the world. Most of them, the success rate is very low, and the success rate is low because they have not been patient. The people who have been patient, they have made a lot of money. The only way to make money here in this market is also you should treat your equity also as you treat your gold, as you treat your land. Don't see prices every day. You are partnering in the good businesses of the country, in a high growth country where population growth still is better than rest of the world, where per capita growth is one of the best, where the real GDP growth is 6%, 7%, the inflation is 4-5%. So 12% growth you are any which ways getting. If anyone does a reasonable job also, you will make 15-16% growth on your portfolio, which is a very good return in my opinion in long term, because it compounds at a phenomenal pace. And I also would say that people should, when they see their portfolios on a daily basis, they must also see their additional real estate assets, what is the rental yield and what kind of return they make on them, and they will realize that the amount of returns they are losing by not being in equity, that loss is very, very big. So that's where I will stop my comment, and I think we have run out of time. So any more questions, please reach out separately. uh,
Perfect.
that's it. I'm speaking for 75 minutes, so I don't know how long it will
Yeah.
continue.
Thanks a lot, Sandeep ji. That brings us to the end of the today's webinar. We sincerely appreciate your participation and hope you find the session insightful. Wishing you a wonderful day ahead. Thanks a lot.
Thank you, everyone. Thanks for trusting us. Keep the faith. Next 3 months will